Hey guys, my name is Lorena. Welcome to our channel. I'm super excited for the next 30 minutes. You definitely want to pay attention, only if you want to pass your life insurance test. This message that we're about to share with you was 100% on the test, and we're going to share with you tips and hacks that are going to help you pass it. We did this actually a couple of years ago in Spanish, and we had a bunch of views. Most important than the views, it's a ton of people that pass their test, share their perspective with us, and we're so excited to bring it to you in English. Very grateful to share this journey with you. Let's go. So, hey guys, today we're gonna be going over the different types of policy and making it super simple for every single one of you to be able to take the test. I promise you that a lot of the things that we're gonna be doing here it's a process of elimination. So in my head, I used to get super confused with the three main different types of policies. And so I made this chart that I just put together specifically so that you have the opportunity to learn it the way that I did. So I'm going to be sharing my screen, and then I'm going to be going into the different types. So in my head, here's the way that I draw it. I'm going to show you. Here we go. Here's the screen. Okay, here's the way that I draw it. There's three main types of insurance policies. Okay, and I'm gonna be doing it in here is this. Bear with me for a second. I promise you that this is gonna be good. Okay. So the first thing that I want you to know is that there is policies that are term policies. By the way, you're more than welcome to stop me and let me know that you couldn't understand this. Okay. The second type of policies that we have is whole life, okay? Whole life policies. Third type of class of policy is universal. And then that's it, okay? So every single one of these policies have the same types of rules, okay? Every single one of these policies have the same type of rule in which you actually have the opportunity to, if you understand the difference between all of them, you actually will pass the test super easy. Okay, so we're gonna start with how the policy gets paid. Okay, so the premium, make this red so that it's a different color, that also helps. Okay, the premium on a term policy is always fixed. So anytime you see a term policy is fixed, and if you see fixed, it could be a term policy or it could be a whole life policy. Okay. The premium in a whole life policy is also fixed. What does that mean? It means that it doesn't go up, it doesn't go down, it doesn't change. Whatever the amount is, it's going to be the same for the rest of the policy, okay? In the universal side of the policy is known as flexible, okay? So you know that if you see flexible, you shouldn't even be thinking about term or whole life, because the only policy that has flexible premium is universal, okay? So this whole game is a whole elimination game, okay? So let's look at another line. Whoops. The different types of, when does the coverage expire? When does coverage expire, okay? And that's a very good way of asking the question, because it's actually gonna give you the opportunity for you to, the moment you answer that, then you'll know if it's a permanent policy or if it isn't. So a term policy, it goes for the size of the term, okay? Whether it's 10 years, 20 years, 30 years, okay? In a whole life policy, is known as a permanent, okay? So it's a permanent policy, which means it doesn't expire. It actually endows at age 100. Who knows what that means?
Well, hello. I think that is while, okay, you accumulate the premium amount when the face amount is equal as the benefits amount or something like that.
That's right.
Right?
Yeah, that's right. Okay. There you go. There you go. So here's the way. High five. Okay. So that's exactly it. Okay. Great job. So the way that it works is that if I have $100,000 policy, okay, and I buy it when I'm 25, by the time I reach age 100, the insurance company is going to give me a check for $100,000. Okay. If the policy is 200,000, you get 200,000 back. If the policy is $500,000, you get $500,000 back, but only until I turn age 100, okay? And then the universal policy is also permanent until age 121, okay? So you have a little bit of time. You actually have a little bit of time to deal with that one, okay? So that is the different types of the coverage expiring, okay? So if in the test, it asks you, hey, so-and-so, this policy never expires, or they want to have a permanent policy. So you know you get rid of term, and it could either be a whole life policy or a universal life policy. But if it says, no, this policy, they only want it for a small period of time. If they're talking about a small period of time, guess what? It's a term policy, okay? So moving on, we're going to go into the face amount, okay? So I'm going to make it purple, and we're going to go into how does the face amount work? Okay. And so in the term policy, there's 3 types of face amount, okay? Level, we have increasing, and we also have decreasing, which we also know as credit, okay? Anytime you see credit, it means the same thing, okay? And I'm actually gonna draw it out for you so that you can remember it, okay? So level is very easy. It stays the same, okay? It's constant. Whoops, that's supposed to be a straight line, okay, guys? I can't do anything straight. So just bear with me for a second, okay? So level is just that. It started at $500,000 and it's gonna finish at $500,000. It started at 100,000 and it finishes at 100,000. So if that's the case, what do you think is increasing? Who can tell me what increasing is?
I know that it increased just one time after 6 years.
Almost. No, that's not it. Nice try. Nice try. So increasing, here's the way that increasing works, okay? Increasing works the following way. It goes up. So for example, this one we use, anytime you see it in the test, you're going to see it like, man, my responsibilities went up. I have more responsibilities, right? Like right now, we don't have any children. If we were to have children, responsibility goes what? Up, okay? So increasing, that's exactly what it means. It started at 100,000 and then it grew to 125,000 and then it grew to 150,000 and then it grew to 175,000, okay? So it just keeps on going up. When we're talking about decreasing, it usually is tied to a credit, whether it's a mortgage, a loan that was taken out and stuff like that. And so decreasing is the opposite, right? It goes down. So it starts at $500,000 and it goes all the way down to 0, okay? So whenever in the test they ask you, which one is the best policy that you need in order for you to back a loan? If the lender wants to have a backup in the loan, which one do you think is going to be the best policy?
Decreasing.
Decreasing, okay? So, all right, awesome. Any questions about this so far? So the next one is we're going to do a whole life policy. The whole life policy is super simple, okay? The whole life policy is just level, okay? But there is one exception, and the exception, I'm going to make it red, okay? Exception is the adjustable whole life, okay? And in adjustable whole life is the only policy that could be permanent, but could also be term. It's like a mix, okay? Adjustable whole life, you're gonna see it twice here. And literally is like it's a whole life, but you can adjust the coverage and you can adjust the premium and it can actually go down to a term policy, okay? But every other policy, we're gonna go through like 6 or 7 different types of whole life policies. All of them, they're level. If they started at 100,000, they're still 100,000 at year 100 because that's the check that the person's gonna get, okay? Now, in universal, it's my favorite, okay? In universal, the coverage, the face amount, okay, it stays flexible. What does that mean? Anytime you see flexible, guys, 9 times out of 10 is going to be a universal life policy, okay? So it's universal life policy. And here's another clue. You're going to see on the test a lot of cost of insurance, okay? So if you see cost of insurance, it's also a universal policy. And I'll tell you why in a couple of minutes, okay? The next question that, the next characteristic that these policies have, okay, all of them, basically all of them is how long do I pay these policies for? Okay. So I'm going to write the question down and we're going to go over it. Okay.
How long do I pay a policy for? Okay.
And so this is when a lot of people get kind of confused, especially on the different types of whole life policy, but I'm going to make it super easy for you. Okay. So in a term policy, it's very easy. If it's a term policy, you're going to be paying it until the term is over, okay? So paid until the term is over. So if it's a 10-year term, how long do I pay it for?
10 years.
10 years.
10
Right?
years.
If it's a 15-year term, how long do I pay it for?
15 years.
That's it. Exactly. That's exactly the way that it works, okay? So now we're going to go into the different types of whole life, by the way. If you're able to learn this, you're good, like you're golden. Like I'll say 50% of the questions on the different types of policies is based on this little square that I'm about to give you. So pay attention, write everything down and ask me questions, okay? This is super important. All right, so here we go. The first type of whole life is straight whole life. Okay, and straight whole life, I pay the client pays until age 100. It's that simple. Then the other type of policy, right, is called limited pay whole life. There we go. Limited pay whole life. And this one works one of two ways, okay? I can pay, it's like 20-year pay. You see it like that. Or you see it paid up till age 65. Okay? So what does that one mean? Here's the way that it works. The coverage goes until age 100, right? Because it's under the whole life category. But I get to choose how long I pay. I'm like, I don't want to pay a policy. Like, who wants to pay a policy until they're like 100? I want to see if I can pay it faster, right? So if I'm 25, I have two options. I can pay it for 20, 30, 40 years, okay? And I can say 20-year pay whole life or 40-year whole life. And all that means is that if I'm 25 and I pay it for 30 years, guess what? I pay it for 30 years. I pay it until age 55. Okay. Or you can see it on the test. Okay. As a, let me show you. Or you can see it in the test as a paid up until age whatever. And that's when you see I'm 25 and I paid up my policy until age 50. Okay. So that means I'm going to pay for the next 25 years. So you're going to see it on the test. Just pay attention if it tells you if it's a 20-year pay, that means the amount of years that you're paying, or if it's paid up till age blah, 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 that just means you're paying up until a certain age. And sometimes they'll make you do math, taking the age out or taking the years out, okay? Any questions on this one? Because this one's kind of tricky. We're good?
Mhm.
Awesome, awesome. All right, very good. Guys, questions? Make it help everybody understand. So if you have a doubt, don't even think about like not asking. Please do. Okay, here's the next one. Single premium. Okay. And my girl, her name is Lonnie. Okay, Lonnie, she's part of our admin team. We love her, but she says anybody that has a bunch of money, she calls them Big Daddy Warbuck. Okay. So that's for the Big Daddy Warbucks. Okay. They have single premium. Single premium, all it means is they make a one-time payment. And then after that, they don't pay anymore. So the coverage is until age 100, but I only get to pay, how many times do I pay this policy?
One time.
One pay.
One time. That's it.
One.
That's all you got to do. Okay. Okay. All right. Awesome. Here's the next one. Modified whole life. And this one, I think it was Franny. Franny, you were talking about that one. Okay. Okay.
When you say one payment is like they just pay like if it's for example. So if it's for 15 year, he just pay it at once.
No, so no, single premium whole life, here's the way that it works. I pay it once and I can be 2 years old and that policy is going to be active until I'm age 100. Okay. So, or I can be 65 and I pay it once and that policy is going to be active until I'm age 100. So it's a big chunk of money, boom, that you put into the policy.
Like if you have $20,000 on saving, you can like take a policy and put it on it. That's how it works.
Yeah.
Basically. Okay.
Yeah. And so the 20,000 can buy you, I don't know, 100,000 or 75,000, depending on your age and health. Okay.
Okay.
Very good. Awesome. So modify whole life was the thing that Franny was talking about. This one highlighted, make it like all kinds of like bright little colors or whatever, because sometimes people get confused. Don't get confused, okay? Modify whole life, premium goes up once. So the premium gets modified. It's not constantly, it's not adjustable. The premium gets modified once, okay? And it's usually after 5 years. Okay. Mm-hmm. So this one was the one that you were talking about, Franny. Remember that you said about the premium?
I got confused because
I gotcha. Yeah, it just goes up once. So imagine the insurance company is just kind of like giving you a discount. Think about that, right? They said, okay, so the policy, you got to pay $800, but for the first 5 years, you only got to pay $500. Think about that. Modify whole life is that. It's just like, I got to pay $800, but for the first 5 years, I only pay $500. After that, you got to pay $800. Okay? Okay, very good. Very good. And then the last one, okay, is adjustable. Adjustable. And the way that adjustable works is a combination of term and permanent, okay? And the way that I like to think about it is that it's kind of like a belt, okay? You know how like a belt, if I want to put my pants down, I got to like undo the belt and then like I can put my pants down, but it's supposed to stay there, okay? So if I close the belt and I want to pull my pants up, I got to undo the belt and pull my pants up. So that up and down, we call it, it could be the premium. And so if you adjust the premium, the whole thing adjusts. The coverage adjusts, the amount of time adjusts, and all of that stuff, okay? So think about any time you adjust it, you're adjusting the size of the policy and how long it covers. Does that make sense?
Yeah.
Okay, very good. So that is basically all you need to know about whole life policies. And by the way, here is the cool thing. The name here, the name of the whole life policy is based on this. So you're going to see whole life or straight whole life. You're going to see limited pay. You're going to see single premium. You're going to see modified whole life, or you're going to see adjustable whole life. Okay.
Loaded and graded.
Graded?
Graded.
Graded has something to do with when the person is not healthy. So it just means that they ended up getting rated.
But the premium goes the premium goes up once 5 years too.
Okay, so usually, okay, so that may be specifically to like North Carolina, okay? But the way that they describe that modified whole life, maybe it's graded whole life. It goes 5 years and then the premium goes up. But the way that in real life we use graded whole life is when the person is not so healthy, okay, the insurance company drops their rating, and it makes it more expensive for them to pay for the policy. So maybe that's the reason why even the premium will go up after 5 years, because of the health of the person. Okay.
Okay.
Okay. But it usually has to do with the health of the person. Okay. Now, in the, how long do I pay the policy for in a universal whole life? Who can take a guess how long you pay it for? Is what?
100?
Ever.
It's flexible.
It's flexible.
Okay.
Everything about a universal life policy is flexible. Think about like leggings. You know how leggings, they're like super forgiving, right? Like if you gain a little bit of weight, it doesn't matter. If you get super skinny, it doesn't matter, it still fit you. So it's like leggings are like that. You can like, and they go back to the regular size, which is the funniest thing, okay? So if you would think of a term policy, the term policy is like super strict. It's like those like old school pants that like you, if you gain an inch of weight, it doesn't, you don't fit anymore, okay? The whole life policy is also like that, with the exception of the adjustable one, which is somewhat flexible, but not too flexible, okay? It's stretchy, but not flexible. And the universal life is leggings, okay? It doesn't matter, okay? If you like gain a lot of weight or if you lost a lot of weight, it will still take care of you. That's the universal life policy, okay? So anytime you see flexible, think of leggings and think of universal life policy. Got it?
Yep.
Got it.
Awesome. All right. Here's the last one. Okay. It's like some policies actually make money. Okay. So we're going to ask, the question that we answer is, how does the money grow? Okay. And so this is my favorite type. Okay. In a term policy, does the money grow?
No.
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 Never. Okay. So anytime they're talking about, oh, cash accumulation and blah, 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 you can take anything that says term policy out of the equation. Does that make sense?
Mm-hmm.
Okay. Awesome.
Yeah.
Now, in the whole life policy, there is two types. Okay. It grows at a fixed interest. All of them grow at a fixed interest. However, okay, there is one exception, and it's the one that says, variable whole life. Okay, so I'm gonna type it. Okay, and we're gonna call it variable whole life. Okay, and the variable whole life, here's the way that it works. I'll make it red. When the market goes up, your money goes up. When the market goes down, you lose money. When the market goes up, your money goes up. When the market goes down, you lose money. Up and down, up and down, up and down. That's what variable means. Okay?
Okay.
So does money grow in term policies? No. Does money grow in whole life policies? Yes. What's the strategy it uses? Fixed. What is fixed? Like this. If they said they're going to give you 3%, it's 3% forever. Okay? In a variable whole life is the exception of that, okay? And this one, in the variable whole life, is fixed, meaning the premium is fixed, the coverage doesn't go up, but the account value, the savings component of it, goes up and down depending on how the market goes. Write this down and make it like super bright red or whatever it is that you need to do, okay? I'm gonna write it down. The only guarantee on a whole life policy, on a variable whole life policy, is the
Zero.
face amount. No, not zero. Is the face amount. What does that mean? Okay, here's what that means. If the market goes up and I make a ton of money, awesome. My face amount is gonna be 100,000 and my account value is gonna be a lot. Okay, but here's the thing. If for whatever reason, I think I wrote this wrong, okay? If for whatever reason, right, the market goes down, which right now the market went down a lot the last couple of weeks, okay? And I lose all of my money, I end up being like, like losing all of my money, my insurance will still stay the same, 100,000. So if I die and I have zero money on my account, my insurance will still be whatever I bought it for. If I bought 100,000, I get 100,000. If I bought 500,000, I get 500,000. So if the market goes up, my family makes I make a ton of money, but if I lose all of the money in the market, it doesn't matter because my insurance policy is still 500,000. Make sense?
Yeah.
Yeah. Okay. So I'm telling you that because that pops up on the test. The only guarantee that a variable whole life policy offers is their face amount. That is it. Nothing else is guaranteed. The risk is run by the client. Okay. Now, in the universal life policy, there's 3 types. Okay. There's the universal life, which is fixed. Okay. Boop. There is variable universal life, which is what we just went over, right? It goes up and down with the market. Beep, 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 beep. Okay. And then there is the index universal life index, which offers guarantees. So if the market goes up, your money goes up. If the market goes down, oops, hang on. If the market goes up, your money goes up. If the market goes down, there's a floor. Okay, so it's 0% risk, 0 risk. I'm gonna write it, 0 risk. Okay, any questions regarding this? Okay, so guys, here's how I use this square. If I were you, I will learn how to do it. Pa, 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 pa. Okay, and in the test, I know that Adelmis was asking me today. She's like, hey, sometimes whatever is in the concept, I don't understand in the test itself. How do I identify it? For me, the way that I did it was a way of elimination, okay? So we're gonna run an exercise right now together, okay? So I'm gonna say something and you're gonna tell me which one I should eliminate, okay? So the client decided to have wants a policy for a short period of time. Which one of the 3 types of policy is it?
Term.
Okay. He wants it to cover a loan. Which type of term policy is it?
Decreasing of credit.
You got it? Perfect. Okay, awesome. So, and that's the way that it works. By the way, here's another hack. This is my favorite hack. You ready? Your mind is gonna be blown. The name of the policy for term policies is either level term, increasing term, or decreasing term, okay? In the whole life policy, it's either straight whole life, adjustable whole life, a single whole life, limited pay whole life. So it's based on how often it gets paid, okay? And on the universal life, it's based on how the money grows, okay? So I know if they're asking me about how the money grows, 9 times out of 10 is gonna be a universal life policy. If they're telling me, oh, the client only wants to pay for 20 years, but he wants the coverage that is permanent, which policy is it? What do you guys think?
Limited pay.
Limited pay.
Bingo. There you go. Great job, right? Or you can see it as limited pay or you can see it at 20 pay. Whole life. It's the same thing. You got it?
Yep.
Okay,
Yeah.
awesome. The client wants to make sure that they have as much flexibility as possible. Which policy is it?
Universal.
Universal, okay? Now, a lot of people, here's another hack, okay? A lot of people get confused between variable whole life and variable universal life. Here's a way that I quickly identify the difference between variable whole life and variable universal life. Anytime they're talking about cost of insurance, I'm gonna make this another color. Anytime they're talking about the cost of insurance, I'm gonna make this green. Okay, it's automatically universal. Okay, I'm gonna say that one more time because it's super important. Anytime you see the word cost of insurance or seguro, costo de seguro, okay, in Spanish, you're actually, it's automatically gonna be a universal life policy. Okay, because the universal life policy is separate. Here's the insurance, here's the savings. In the whole life policy, it's like a scrambled eggs, okay? With like all of the stuff in it, which is like, it's all together, right? So all of my stuff is put together in the whole life policy. So my savings and my insurance is all together. But in my universal life policy, here's the insurance, here's the savings. They don't mix and match, okay? Any questions about this?
Well, yes and no. So, maybe you can answer me.
Okay.
Wow, veo la diferencia. Tú sabes, the difference that I see between universal and variable for life is always, I look.
You muted yourself. There you go. Now we can hear you.
Oh, I'm sorry. Okay. Because when I see by the questions, right, always when they say interest, I put that by universal. And always when they say investment, it's variable.
Okay. That's another great hack, by the way. Variable is investment. Investment is variable. If you see the word variable, if you see the word, what is it? Variable. If you see the word mutual funds, stocks, all of that stuff. If you see investment, it's variable. All of the investment, mutual funds, stocks, bonds, all of that stuff is variable. Now, it could be one of three variables. It could be variable whole life. It could be variable universal life, or it could be variable annuity even. Okay, we're not going to talk about annuities today, but it's because it's just the way that money grows. Does that make sense?
Yes.
Yes.
Okay, very good. Awesome. So I'm going to pause this for a second, and I want to make sure that then we have the opportunity to finish that. Here's what I want us to do. I'm going to access one of the courses. Glenda, I think I'm going to go into yours. Okay, so that we have the opportunity to practice a couple of questions. I want to take the next 20 minutes to just practice a couple of questions. So
there you have it, guys. I know that we brought value to you. That was actually one of the live classes that we did with some of our agents. Excited to help you pass the test. Please let us know what were some of your biggest takeaways. What tip, what hack actually helped you pass the test. Don't forget to connect with us on social media so that you can let us know your questions, comments, concerns, and jokes. Okay, most importantly, the jokes. I love jokes. Don't forget to comment, like, subscribe, and share. And most importantly, we're looking for some good people. If you know anybody, or maybe even yourself, you're looking at making a career in this industry, go ahead and reach out to us. Can't wait to connect with you.